Dear friends, in today's video, I would like to discuss the business of banking and bank balance sheets or credit creation by banks. Remember that this is an important part of the syllabus of BA Economics in universities in Kerala and also outside. We know that the creation of credit is regarded as an important function of the modern banking system. A bank is sometimes called the manufacturer of credit because it creates credit. That's why it is known as the manufacturer of credit. Banks receive deposits from people. Banks use these deposits for lending. But banks keep a part of the deposits as reserves and lend the balance part to its customers as loans. In this process of receiving deposits and lending loans, commercial banks are said to be creating credit. We explain the process of credit creation when there are several banks in the country. Here we assume that cash reserve ratio is 20%. It means that of the total deposits received by commercial banks, 20% will be kept as cash reserve and the rest will be utilized for giving loans to borrowers. We shall illustrate how an initial deposits of rupees 1 lakh leads to a total deposits of rupees 5 lakh. Let us suppose that an individual deposits rupees 1 lakh with bank A. Now the balance sheet of bank A looks like bank A on asset side we have rupees 1 lakh. The same 1 lakh appears on the liability side as deposits. Now bank A keeps rupees 20,000 as cash reserve as rupees 80,000 will be given as loans. When a bank lends, it does not give cash directly to the person or to the borrower. The bank makes deposits in the name of the borrower and gives him the right to draw checks against it when required. That means the person who has been sanctioned the money can withdraw the money from the bank using the check. So when bank gives a loan, a deposit is created in the name of the borrower. That means every loan creates a secondary deposit or a new deposit. Now the balance sheet of bank A when the bank loan is sanctioned, but before the borrower withdraws the amount, looks like as given below. So this is a bank balance sheet of bank A after sanctioning the loan, but before withdrawing the amount. On asset side, we have the cash 1 lakh. The same 1 lakh appears on the liability side as original deposits. And on the asset side, the loan that is 80,000, this loan has been sanctioned, but it is not withdrawn. So it appears on the liability side as the new deposit, rupees 80,000. On the asset side, we have the total 1 lakh 80,000 and on the liability side, we have total 1 lakh 80,000. After the newly created deposit is withdrawn, the bank balance sheet of A becomes bank A balance sheet. On asset side, we have the cash reserve 20,000 because 20,000 will be kept as the reserve by the bank and the balance 80,000 will be given as a loan. So total 1 lakh. Liability side, the original deposits appears at 1 lakh. A new deposit becomes zero because the amount has been withdrawn by the borrower. So total liability side 1 lakh. Now suppose that the borrower of rupees 80,000 from bank A deposits the same amount with another bank B. Now the balance sheet of B will look like bank balance sheet of B. On asset side we have 80,000 as a deposit. Then deposit becomes a liability for the bank. So on the liability side the same rupees 80,000 appears as a liability that is under the HUD deposits. Now bank A B keeps rupees 60,000 as cash reserve and it gives rupees 64,000 as loan. 20 percentage of this rupees 80,000 is kept by the bank B as cash users. That is 60,000 will be kept by the B as cash users, and the rest 64,000 will be given as loan. When a bank lends, it does not give cash directly, but it makes deposits in the name of the borrower and gives him the right to draw the check against it when required. So it's a new deposit. Now the balance sheet of B when the loan is sanctioned, but before the borrower withdraws the amount, it looks like this. Bank B balance sheet on asset side 80,000, loan amount 64,000, total 1,44,000. Liability side we have original deposit 80,000, new deposit 64,000, totaling 1,44,000. After the newly created deposit is withdrawn, the bank balance sheet of B becomes Bank B balance sheet. On asset side, cash reserve 16,000, loan amount 64,000. But on our liability side, we have the original deposit rupees 80,000, and new deposit now has become zero because the loan amount has been withdrawn by the person. So on the asset side, we have the total 8 rupees 80,000 and liability side 80,000. So this process will go on in the banking system. We can now state how much total deposits will be created out of the initial deposits of rupees 1 lakh. So total deposits 1 lakh, that is original deposits. Then a loan of 80,000 has been created. So this is a secondary deposit. Then again a 64,000 loan has been created. That is another secondary deposit. Totaling we will get rupees 5 lakh. So how do we arrive at this 5 lakh? Now see, there is a total deposits expanded is 5 times the original deposits. So 1 lakh was our initial deposits. Now the final deposit is 5 lakh. So it is 5 times higher than the original deposits 1 lakh. That means final deposits rupees 5 lakh is 5 times of the original amount rupees 1 lakh. That is, deposits of cash in the banking system leads to multiple expansion in the total deposits. This is known as deposit or credit multiplier. We can find out deposit multiplier as follows. Deposits multiplied is equal to 1 by R, where R is the cash user ratio. In our example, R is 20%. So 1 by 0.20, that is 5. This means that total deposits rupees 5 lakh is 5 times the initial deposits of rupees 1 lakh. So it means that the initial deposit of rupees 1 lakh has led into the creation of a final deposit amount of rupees 5 lakh. So this clearly explains how the banking system in our country creates credit.